back. I guess I said a few things that you guys liked last time, so John had me back here. For those of you who are a little bit new to the whole process here, John has brought me on sort of as a little bit more of the investment consultant side of it to kind of structure different strategies for your portfolios. So today we're going to have a little sneak peek of that. Right here, this is just going to make the lawyers happy. What we're providing here is just a look into what we do. It's not going to be any sort of promise of future returns, and it's just our opinion, John and myself, and not those of advisory service networks or compliance companies. Okay, that being said, if you're a little new to this and you haven't met me before, I'm glad to be here. My name is Matthew Inouye. For those of you who were here last time, this is a repeat. But I was born and raised in Kailua, Hawaii, and lived there my whole life until college, became an electrical engineer, worked with the Navy, shot rockets off of aircraft carriers, big explosions, very fun. But during that whole time, I was really interested in stocks. I have been from a very young age. My father got me into it. So investing has just been something I like doing, and I do it with the stock side. I'm a research analyst for William & Leon Company, or a former research analyst. Now I trade my own money, and I'm also a co-founder of Shinko Management, which is a real estate investment firm. So this is kind of my background, and now I'm sort of working with you to build some of these different things we're going to show you today. All right, and if we can get the clicker to work, there we go. All right, so the topics of discussion today, we're going to talk about the market huddle. Now, anybody been reading the newsletters we've been sending out on a monthly basis? Yes? Okay, good. So what I wanted to use this opportunity today as is to kind of explain what we're looking at when I circle certain things, when I point arrows to different things. What are we talking about? What's the message we're trying to get across in those newsletters? We're going to get into the strategic investing portion. So this is sort of the thought process of how we build different portfolios. And finally, we're going to talk about the sum total, which is the JCN Visio model portfolio. So this is basically all our research and development has gone into creating these different portfolios based on risk levels. All right, so real quick, let's go into the market huddle. Now, last time that I came down here, we talked a little bit about some, I guess, basics in terms of chart reading and how to measure trends within the market. So just really quickly, a recap. The red line here is your 50-day moving average. Generally, we like to see that sloping up. The black line is the 200-day moving average. And all it is just a slower moving average. It's taking a longer time interval. It helps to smooth out the volatility and see if you're in an uptrend or downtrend. So this is the S&P 500 really quickly here. And one of the things that I just wanted to point out is when we look at the market, a lot of people have been asking us, well, what's happening with the market? Where do we think it's going to go? A gentleman just asked me earlier today, how do we think the Iraq situation is going to impact the market? And the question to all of the above is, we don't know. And the real truth is, nobody knows out there. Not the big broker houses, not some broker out there. So the thing is, the best we can do is look at price and volume, which is on the charts. The charts represent the collective buying and selling of all investors across the whole world. So if this starts to go up, that means people are bidding up prices. They're willing to pay a higher price for that S&P 500. Think of it as cattle. I actually have had the pleasure of going to a cattle auction recently. And the way that they auction it off is you have a whole bunch of buyers in the beginning, they bid up the price of cattle, and that's essentially what happens here. Think of your S&P 500 as your inventory. This is livestock. This is things that help you make money. And what happens is there's a certain point where buyers stop buying, or they won't pay a higher price. Now this is what we call resistance in the stock market, when there's sellers who are willing to sell, but no buyers who are willing to pay a higher price. Now when you start to see these happen in succession, they start to form a pattern in the same region where buyers don't pay a higher price, that's what we call resistance. And a lot of times on the charts that you'll see on the newsletters, these are the areas that we're highlighting. Because it's very important to know when a buyer is not seeing value in the current marketplace. Now there's a concept in technical analysis, which is what chart reading is, where once an area is breached and buyers do decide that they want to pay a higher price for something, that area now acts as support. So this kind of actually just illustrates the most recent 6 months action in the S&P 500. And we had 3 areas of selling occur. And one of them actually got us pretty good. It was right after that speakers bureau that we had in January. But the market recovered, found a little bit of resistance, finally punched through. And now you're seeing this area serve as a place of support. This is where buyers are saying, you know what? The S&P 500 is coming back to this 18,500 level. We're going to buy it. It's a good value. So this is something that we want to keep in mind, is that old resistance becomes new support and vice versa. Old support will now become new resistance if you fall through that support level. So now let's look at the S&P 500 currently, and what we've noticed is in this range, you've had, let's go back, so you've had this area of support. Now you're starting to see a slight area of resistance form, and we broke out of that about a month ago. Now we're actually trading at all-time highs. So the question becomes is, well, where do we go? We don't know, but we do know that if we are to continue higher, this general vicinity of 1900 has to hold. If you go down to 1900, wobble around for a few days, and then you undercut it, what it means is that all the buyers who thought it was a good deal here at 1900 in the past have evaporated. There's nobody left who's willing to buy it at 1900. So this is a very, very critical area. Basically, for whatever reason, investors get tied to whole numbers. It's just an easy thing. I want to buy 1,000 shares of something. I want to buy 100 shares. It's kind of weird to call up your broker and say, hey, buy me 267 shares of something. You would rather just say 300. It's sort of the same thing with the market, where once you hit a round number, sometimes it'll act as just a psychological resistance for the first few times, and once you punch through, it needs to hold that whole number level. Okay, let's move on to a different index. One quick thing. One of the things that we talked about in the last Speakers Bureau is how we look at volume as a way of noticing conviction behind the move. Volume indicates how many people are willing to buy and sell at a certain price. And one of the things we watch for is when selling starts to occur in heavy volume. That means that people they have conviction with getting rid of their stocks. So what we saw here is there was heavy volume clustering during that February sell-off. The NASDAQ sold out very hard in this April area, not so much on the S&P 500, which are larger cap dividend-paying stocks, but we are starting to notice that you're getting more heavy volume clustering on the updates, which is a positive development. So I guess the best way to put our stance is we're cautiously bullish. We never know where it's going to go, but there are some signs appearing that we may be kind of recovering out of that sell-off a couple of months ago, at least in the technology stocks. Any questions on this? No? Okay. Let's move on to the NASDAQ. Now the NASDAQ is really the index that got hit the hardest in the March and April sell-off. This actually sold off top to bottom 9.9%, almost the definition of what a correction is at 10%. A lot of the names that you'll see, Tesla, Facebook, Google, Priceline, all of these leading stocks that have innovative technologies that are changing how we live got hit the hardest. And one of the things we look at in terms of technical analysis is not only the moving averages, but we sometimes string together a series of highs and series of lows. The highs and the lows, if you connect them up, kind of give you a general area of when the trend is starting to change. So right in this area, we noticed, and I think one of our newsletters went out in this area, that this is when we started to get cautiously optimistic. Say, hey, you know what? Maybe the selling is starting to slow down and the buyers are starting to step in. So this is one of the things we're looking at here. But then with technical analysis, there's no just one answer. You want to always step back and take a look at the big picture. So even though we were breaking out of a trend in this one smaller area, if you take a step back and look at the big picture, what you're starting to notice is that there are very clear areas of support and there's very clear areas of resistance forming. Now right now the NASDAQ is actually, I think right now trading right at about 4,400. But this is going to be a very important chart for you to remember. In about 10 slides, we're going to show why this is so important, why we're still just cautiously optimistic, even though the markets are at all-time highs. It's kind of funny that when you look at most corrections in the market, it actually occurs near highs. And that's because everybody is flush with cash. They don't consider risk. Everybody's high-fiving their buddies at the cubicle, saying, hey, look at what my 401k did. And when there's no fear in the market, that's actually when it's time to be the most fearful because everybody's invested. So we need to be very careful at this particular moment in the market. Let's go on to, you see this very clear area of support, and it doesn't stop on the dime. Support and resistance is a general area where people think things are expensive and when they think it's cheap. And so we see this general area of resistance forming. Now that we've broken through, actually I think we're trading at all-time highs as of yesterday. This area at 16,500 is going to be very critical if we are to continue this rally. We have to hold this area. Otherwise, it's signifying that all the people who bought it during this time no longer want to buy the stocks that make up the Dow Jones. Any questions? Okay. Now on to the Russell 2000. John had asked the question, well, what do we think is the best performing asset or stock class? Is it small caps, mid caps, big caps, international? Actually, the small caps have had one of the worst years this year. And that is, yeah, it's kind of funny to see that. But when you look at this move down, it went from about 1,200 down to 1,100. So that's, just about a 10% move down as well. And similar to the NASDAQ, we see that there is a trend line forming where there's a series of higher or a series of lower highs where we can draw a trend line. So now that we've sort of punched through that area, again, it gets us cautiously optimistic. But when we look at the bigger picture, we notice there's clear areas of support over the last year and a half where buyers have stepped in and said, hey, the Russell's a good value right here. Small cap stocks are good value. But in the grand scheme of things, when we look at these highs, this is a concept that we covered in the newsletter. It's called a head and shoulders pattern. Essentially, when you look at buyers and sellers, this is one of the bigger topping patterns in most technical analysis books. Essentially what it's saying is that buyers are willing to buy it up, and then there was a short-term correction, and they were willing to buy it up and pay a higher price than they did 3 months ago. And then there was a correction. That's normal. But now, all of a sudden, they're willing to buy it, but they're not so sure they want to pay the prices that they did 3 or 4 months ago. So what now happens is, this does not mean it corrects just because it's for these 3 series. But now this puts extra emphasis on this support level that has held for the last year and a half. If we start to see this crack at 1,100, what it really means is that people are selling small cap stocks. And the reason that's very critical for us to understand is small cap stocks are very, very sensitive to the economic cycle. Big companies like Google, Microsoft, Apple, they've got hundreds of billions of dollars in cash. They can withstand a downturn in the economy. Small mom and pop companies, small technology and biotechnology companies have a lot of debt on their balance sheets. That's how they're funding their new research. So as the economy stalls, if they don't sell equipment or sell products or services, it's going to really drive their revenues down. They may not be able to meet their income expenses from all of these loans. And so now their companies become in trouble. So small caps are very sensitive to the overall economic cycle. So this psychological support level is going to be very key for us to watch in the next few months. Any questions on this? Next thing, and by the way, if I'm going a little too fast, say, hey, can you back up and cover that concept again? So the final thing that we've been kind of putting to light in a lot of the recent newsletters is the bonds. Now the TLT is an exchange traded fund. It's an ETF that melds the 20 and 30-year US government bonds. So these are longer dated bonds that tend to pay higher dividend yields. And what we've noticed is that over the last several months, actually this goes back to September of last year, there's a series of highs that the bonds could not breach. And in the most recent action, we've noticed that it's actually been able to breach and hold above these general highs of the past. So what that means is people are buying bonds. Let me ask you a question. When do people buy bonds? What's the main reason? Stock market's falling. So there's a risk aversion, right? We would rather have a guaranteed 2 or 3% return for the next few years than a potential return for 10, 15, 20% in the general market. Right? So what it's saying is people are getting a little nervous about what's happening in the economics, in the global political space, Iraq, Syria, who knows what it is, but people are getting nervous. So what we're noticing here is that we do see that people are willing to pay a higher price for bonds. They're wanting to lock in this longer term interest rate. And John was very right, the year-to-date return of the bonds have been the best performing asset class so far of 9.6% year-to-date. And that's on the TLT. The bonds themselves have actually been a little bit higher. But this is where it was January 1st. remember, market was at an all-time high at that point. People were very not worried about risk. Actually, they were selling bonds off. It was at a low. Over the last 6 months, you've seen a shift in an allocation that they're starting to lock in something that's a little bit more risk averse, guaranteed by the full faith and credit of the US government. So this is something we're watching. This is why we're a little bit cautious. And the real answer is because when you look at the different areas of investments and money, you start to get a sense of an investor's fear, greed, psychology. In essence, you know, people play poker here? You guys play house games? Okay. You ever had a friend that you can just tell he's got pocket aces, he's all giddy, he's smiling, he can't help but the same, you know, he's raising all in off the first hand. And what it is you're really just noticing certain patterns in his behavior that dictate what he's holding in his hand. And we use that information in poker to place our bets, to try to strategically outthink him. It's the exact same thing when we look at bonds, or gold, or anything else. In fact, let me switch out. I just wanted to pull up a chart of the gold. Actually, has gone up. In the last 2-3 days, it's up about 60 points. And gold is normally an inflation hedge, right? I'll just explain to Rick over there that in the grand scheme of things, gold is a horrible investment. You pay money to go and find gold. You pay money to dig it out of the ground. You pay someone to refine it. You pay someone to go and lock it up and secure it in a vault. And you pay someone to go bury it back in that vault. It doesn't produce any assets for us. But what I told him is that, you know what? I'm not going to mess with 3,000 years of human stupidity on how bad investment gold is. It has been an asset class since the Mayans and before that time. So for us, when we start to look at gold, and gold is up 60, 70 points in the last 2 or 3 days, what it could potentially be meaning is that people are worried about inflation. That's why they're moving to gold. The stocks, they're going up a little bit, not a lot, because stocks can do well in an inflationary environment. You just don't want too much inflation. It's a Goldilocks scenario. You don't want too hot, you don't want too cold. And then the bonds, we're watching that because people are a little bit, I guess, risk adverse in this current marketplace. So we take a look at all these classes because it gives us an idea about the psychology of other investors. Mainly the big investors, institutions, banks, mutual funds, pension funds, insurance companies. So what I wanted to do is just go through a quick exercise of why the bonds are of importance to us right now. It's a pretty big correction, right? Yeah, it was a 55% correction top to bottom in the S&P. What we noticed is that in 2006 it hit a high, market kept chugging along, so people sold their bonds, and all of a sudden there was a shift. People started buying bonds. The smart money started to buy bonds. The stock market still went up, so if we just looked at the stock market, we wouldn't be any wiser that something was occurring underneath it all. Now, just like with all the other charts we're looking at, there's a place where sellers overpower the buyers, the stocks retreat, or the bonds retreat, and then right back at it, the buyers say, you know what, I'm going to buy it up again. And so now you're at a battle right in this area, and once the bonds win, buyers of bonds win, that means they're really seeking to get risk off the table if you're buying bonds. This is where this 1114 occurs on the S&P 500 chart. Now we don't want to use this as an area of, anytime the bonds break out, we sell all of our stocks. That's not how it works. What it does though is it does give us an area where we need to be a little bit more cautious. If somebody wants to go into some of our more aggressive models, maybe John can say, hey, here's some of the things we're noticing with the other asset classes. It might be more prudent to take a different approach. But this is the kind of research that we're doing together, John and I. And one of the things you'll notice, look at the overall topping pattern of the S&P. You notice there's a series of highs that the market can't go through. There's a series of lows that the market gets supported at. And finally, when those lows get breached, that's where you see the cascading effect. But even before we breached this low, the bonds were giving us a heads up that people were shifting to more risk-averse investments. Any questions? The market's still falling apart. Lehman Brothers went bankrupt, Washington Mutual, Bear Stearns, the IG's in trouble. And again, you have a high point in the bonds, and then the market kind of settles down. People sell bonds, but then they start to buy it up, and you have these series of resistance areas, places that people want to start buying bonds. And once you break through, this is 2008, you have another sell-off. Now on the chart, it doesn't look like a lot, but from 950 down to 666, That's a 25% sell-off. That's a lot of money you could have lost during that period. And again, the bonds gave us a heads up about 2 to 3 months in advance. So you see why we don't want to use the bonds to just sell all of our stocks, but we want to use it as an early tell. This is what we call a market tell as to what other players at the investors table are doing. What cards do they hold in their hand? I think one of the most impressive pieces of what the bonds have done is in 2011. Bonds were being sold off as we recovered off of the 2008 lows. Everybody sold their bonds. And all of a sudden, you start to see sort of this bottoming pattern right in here, where you see that there's clear areas of resistance. The bonds break out, encounter more sellers, but you see how old resistance now becomes the new support. So now this old resistance, once this breaks out, we need to really start paying attention. People are all of a sudden risk adverse again. Why are they risk adverse? We don't know, but all we need to know is that people are moving money out of stocks. So right here, let's remember this, 5.5, 7.29. Look at where 5.5 happens at all-time highs in the market. Does that kind of ring a bell for anyone with this current market? Bonds are moving, market's at all-time highs. So we're not, that's why I say we're cautiously optimistic. We could continue higher, but we have seen in history where the bonds can give us a few months of heads-up lead that people are more risk-adverse. By the way, 729 was just 3 days before S&P downgraded the U.S. debt, the credit rating. And that really caused, I think it was like a 23% sell-off in just about 2 weeks. And more important is, let's take a look at the overall picture of the market. You notice something very similar? They all have a series of resistance areas where they can't get through, buyers can't get through, and finally once that support area breaks, people are saying, you know what, I'm not going to pay $1,200 for this S&P merchandise. Think of it as a merchandise, a shirt that you go out and buy. I'm going to wait for a cheaper price. And that's exactly what causes a sell-off in the market. So, going to the current marketplace, now I think it puts it in perspective why it's so important on the NASDAQ, which has a lot of our leading stocks, why we're watching these support areas, and why we're carefully monitoring how the resistance areas are forming, and we're putting that in conjunction with the action in the bonds. This is critical to our decision-making process on if it's a time to be a little bit more risk-taking or risk-averse. Any questions?
Would you go back to the previous slide? I was just looking at the volume.
Yeah.
Right at the end.
Right in here?
Yeah.
Yeah. And that volume is just saying that at this point, everybody is just scared, right? They're worried about a 2008 repeat. And if you remember, it's funny how certain topic points get sort of, they become a topic point in the news and the media, or they become sort of forgotten in the next couple of months. But you remember how everybody was talking about a double-dip recession? For, I think about 3 years after 2008, everybody was talking about double-dip recession. Well, you know, that's the thing is when everybody's thinking that this might be the double dip, well, I better get out before, you know, the next person next to me does, that's what causes these panic sells. And so again, we're watching how smart money is shifting in and out of bonds, gold, stocks, real estate, and we're trying to get a big picture view of what's everybody's assessment of the market. Because at the end of the day, the only thing that gauges the price of any asset is what buyers and sellers are willing to pay for it. So all we need to do is watch the buyers and the sellers, which is watching the charts.
Is there ever what I call a dead cat bounce?
Off of this?
Well, around 2008 or, you know, after
There was actually quite a few. And so that's, you know, that's one of the things that you'll see is that dead cat bounce is referred to as it sold off so much that, you know, basically can't help but to go up. You know, the graphic story kind of goes, if you throw a dead cat hard enough, it's going to bounce a little bit. But anyway, that's neither here nor there, but it is a terminology in Wall Street which indicates that there's so much selling that has been done that it can't help but to go up the other way, whether it's shorts covering their position or value investors coming in to pick up value, what they think is value. Whatever reason it is, it does cause the stock to go, or the stock market to lift a little bit. But if you're really truly in trouble, that's when you'll see the market start to continue to unravel, the bonds will continue to go up, and you know that's where you'll see this kind of unfold. But that's a great question. Oh, I guess we should do the takeaway. So I think one of the things we make very clear in the newsletters is we're not predictors. We're not stock market prognosticators. All we do is we just try and interpret the data that's given to us every day. Now that data today might change with the data I get on Friday. It might make me feel different about the market. But the main thing is we are always looking across the field to see what's going on to help us make better investment decisions. Okay, this is something that's a little bit new, I think, to most people who have dealt with a more traditional broker or a traditional financial advisor. Most times you might encounter a broker who say, you know, Jim, I've got this hot stock for you. I think you can make a lot of money. What does it do? I don't know. It's a biotech company, right? That's usually how the conversation goes. What we've done is we say, you know what? We don't want to go off of our gut feel. We want to actually have statistical evidence that what we think is going to make a stock goes up actually works in multiple occurrences in multiple markets across a long range of time. That's how we know that there's truly some kind of an edge to the system that we have. So the answer to what is strategic investing for us at JCN, it's something that's systematic, it's rules-driven, it's rules-based, it's disciplined and quantifiable, so we're no longer saying, you know, I think the market's good or I think the market's bad. We're just going off of what the models say. It seeks to meet one or multiple goals, whether it's I want to get more return on my money or I want to reduce the drawdowns and the volatility of my account. We can go ahead and design these to try and meet different goals. And most important to us is the thought process is just as important as the end result. A lot of times people confuse end result with how good a strategy is. You know, say a broker got you into Apple in 2004, went up a bunch and you made a ton of money. Well, that's great. How did you do in all the other stock picks? Did he just get lucky or did he have a proven system that he can go out and now repeat on other stocks? The saying that I kind of use is a blind hog finds an acorn every once in a while. So to us, even though the end result might be good, if we're looking at the data and say, you know what, we just got this by chance. Even though the data is showing us that this would have done very well, it might have been just luck, then that's not a good strategy for us. We want to have proof that something works over time. Okay, so the advantages of having a strategic investing approach for us. If we can click. Well, in order to explain the advantage, I think it's very appropriate to look at what sort of is a conventional approach versus what we're trying to do. So a conventional approach would be sort of what a friend might tell you is a good way to invest. It might be a broker who's just commission driven. But in essence, I think this is probably the most conventional thinking in Wall Street right now. When the stock market goes down, you call your broker and say, hey, should we sell? So don't worry, Jim, just buy and hold for the long term. We're in this for the long term, aren't we? And to us, we say, well, we should test that. Is buy and hold really the best way to make an investment? So what we did is we actually took the market from 1998 till current. Now remember in January, we only had data back into, I think it was about 2009. So what we did is we said, we need to study this further. We need to have more data points to make a more conclusive decision. So this is just the S&P from 98 to 2004 with dividends reinvested. This returned 107% in 15 years. So you doubled your money in 15 years. It's not bad, but it's not great either. But in order to get that 107% return, you did have to sit through a 55% drawdown in 2008 and a 45% drawdown in 2000. Now the hardest thing about buy and hold are the drawdowns. The drawdowns make it hard to stick to a discipline. Because when you see your $1 million account go down to 400,000, that's when most people hit the eject button and they just sell everything at the bottom. So our goal is to try and come up with something that reduces drawdown so that we don't panic. So here's a look into our thought process and if we employ a simple rule. If you're higher than you were 100 days ago, you buy and you're in the market. If you're lower than you were 100 days ago, you sell. You're out of the S&P spiders, SPYETF. Okay? Very simple, wouldn't you agree? Just one rule. Well, let's look at the results. So the blue is your S&P. The red is this simple one rule. Buy if you're over 100 days ago, sell if you're under 100 days ago. So the return is 129, almost 130% versus about 107. So you did better over 15 years, not a lot, but a little bit. But look what happened to the drawdowns in 2000. You see how you kind of just went flat? While the market kept selling off, even more so in 2008, this was very apparent. There's just a flat period while everybody else is losing money. So the drawdown on this type of an experiment was 23%. Now, is 23% a little bit easier to hold through than 55? Yeah, absolutely. Now, is it still easy? No. But at least we have some kind of system to get us out of the market. Not a very complex one, but it's some kind of a system. Can we improve upon those results if we add another indicator? Mainly the analyst expectations for earnings for the S&P 500 companies. Right? So keep in mind, GE or Microsoft or Google, they probably have 20 different analysts from different broker houses or research firms that all come up with price targets on what they think the earnings are going to be based on how much product they sell, based on the cost of all the underlyings. So they come up with these projections on what do we think is going to happen to the stock. And what we're saying is if all the analysts in the world are covering the largest 5 companies in the world are saying that earnings are either going up or we think earnings are going down, how does that further impact our strategy? Let's look at the results. This is the blue line, S&P 500, 15 years of data. This is the red line with just one rule. The green line is adding another rule. Over 15 years, you return 327%. Now we're talking. That's a significant improvement by just adding 2 rules to how we invest our money. Again, the best we were able to do with just one rule, the 100-day rule, is 129%. So we've almost tripled our return. But look at this period. I like this because look at, you have a couple of false positives. You go flat, flat, flat. There's 3 areas you go flat with the other rule. You just have one flat. You're just out. And it gets you back in. So when we combine these 2 rules, we actually get a much greater return. And our drawdown was reduced to 18% versus the 22 in our first experiment versus 55 overall. You had a question?
Matt, what triggers you to get back in the market?
It's just the opposite. So if the market is higher than 100 days ago and analyst opinions are higher on the S&P 500 companies, that triggers the rule to get back in.
Okay, can that be the day after you got out?
The day after you, it could be, but this is actually a weekly rebalance.
Okay.
So it could be the week after, correct?
Okay.
To say that this is actually not a bad approach. It's quantifiable. We've tested it with a database that we actually have purchased, and it has testing rules and ability to code different simulations. So this is actually not bad. But to further kind of show us what we're doing in terms of strategy development and risk management for the clients of JCN, we're not just judging a strategy by the overall return. That's just one element of a financial goal, is the overall return. There are other elements that we'd like to look at. Drawdown, volatility, how much trading activity occurs. All of those are considerations for what makes a good investment for a particular person, right? So let's take a look at some other metrics. So here we have buy and hold at the top. Here we have our first experiment, just the 100-day. And we're going to compare it to the 100-day and the analyst in just a second. But let's go through this one at a time. So total return 106 for buy and hold, 129 for our 100-day rule. That's good. Drawdown 55% on the buy and hold, 22.9% on our experiment. That's good too. Buy and hold turnover. You just bought it and you held it and dividends are reinvested. There's 0 turnover. You just bought it once and you just held it, right? Look at the annual turnover for buying it and selling it with just the 100-day rule. Now, 200% turnover means that if you have a $100,000 account, that means that you've traded $300,000 of activity. So you bought it, sold it, bought it, sold it. Within a year, you've traded 200%. Now, that's not good if you're in a taxable account. If you're in a non-tax, not as much of a deal. There is still slippage and commission that might eat you up if you were in a normal brokerage account. Again, John doesn't charge commission.
Don't use that word.
Yeah, that doesn't exist within JCN. It's all included. So this 207% really is a consideration if you were doing this on the outside. So now let's break it down and compare buy and hold to our second strategy, the one that had the higher performance. So what we're seeing here is 106% versus 327%. That's excellent. Match drawdown, 55% versus 18%. Again, excellent. Let's look at our turnover. So because we added one additional filtering criteria, we've actually reduced the turnover to a very, very acceptable level. You only turn over your portfolio, 20% of your portfolio once a year. The fact that it saved you so much in the drawdown and it made you so much more on a 15-year period, this might be a better strategy to pursue versus the first one. These are the different things that we start to consider when we're looking at different investment strategies. And questions? Observed the experiment A. We could have reduced drawdown, which was one of our goals. We didn't want to sit through a 55% drawdown. But it was at the cost of increasing turnover in our portfolio, which is something that we didn't desire. If we did the 100-day plus the analyst, not only did we improve returns, improve the drawdowns, but we've also reduced the turnover from the first experiment. It's still not as low as buy and hold. Nothing ever will be that low. But we reduced it to an acceptable area. And that's how we start to make investment decisions and strategies. Okay, so the takeaway through this is, you see how the thought process is very critical to us when we start to choose different strategies and what is good and what's not good. It's not just based on the end result. If it was just based on the end result, that first strategy we looked at might have seemed pretty feasible. But you have to look at all the different areas within what makes a good strategy to be able to make a good determination. This is going to help us to better manage the risk for JCN financial clients. It's going to hopefully help us improve on returns. But really, most importantly, this is going to be an important tool to helping everyone achieve financial goals on this one.
Strategy.
And this is a Visio strategy, and actually that's something I'm going to talk about. The Visio strategies make up the Visio model portfolios. Now, model portfolios are allocated, and I'll show it just in a second, based on different risk tolerances, but all of these different strategies that we've been working on are in the sum total of a portfolio, and we model those portfolios based on risk. So I wanted to take a quick minute to talk about what Visio means. Well, it's a Latin word for sight. It's our ability to see events, to foretell events, and to use our collective knowledge to help better improve upon what we see occurring in the future. So what we've done is we've created 6 different portfolios based on our different strategies. And it goes from conservative to ultra aggressive. And essentially, we have portfolio models for bonds, we have portfolio models for stocks, and actually, because of the move in gold recently, I've been actually working on a gold model, not actually recently, this has been from the start, because I do believe gold does play some part in a portfolio. We just have to model something that has good strategic risk versus reward. So right now, it's just going to be stocks and bonds, but eventually, we would like to introduce other asset classes into this.
Now, they clearly understand that within the portfolios, from time to time, you're going to see changes.
That's right.
With this, so we're not just going to set it and forget it. You will see as appropriate.
This is by no means a final product. And one of the things that I found most interesting about working with John over the last few months, actually almost a year now, is what I didn't know. I've discovered things I didn't know.
Share today.
And he is most, he's been most concerned about educating clients about what they don't know. One of the things is I've lived in a world of trading. And in trading, if you make 2 or 3% in a day, you sell it and go home. This is a different level of strategic thinking. And one of the things that I found is using my engineering background, being able to code and program, and using my market knowledge, I've been able to find things that I didn't think were possible. In fact, I was just telling John, I'm actually probably going to move a majority of my portfolio into these models because I've seen the upside, I've seen the drawdowns, and to me, one of the hardest things about being a trader is going through a drawdown. You could make 67% in a year, but you might have to endure a 30%, 40% drawdown along the way. That's hard. That shakes your confidence if every day you have to go back out into that battlefield and fight another fight. If you just took a walloping the last week, you may make a decision based on fear that next day instead of on opportunity. So to me, one of the nice things about this is that I've actually created something that might be appropriate for my parents to move into, something that I want to move a majority of my money into, and still leave me some discretionary money to trade with. So doing this process has actually taught me what I didn't know. And that's, I think, the most important thing. And we will continue to work to uncover things that we don't know.
When you roll in analysts' updates on stocks for earnings growth, do you use a wide array of different analysts or different firms?
It's a great
Because
question.
As you know, some analysts, if they cover a certain company for a long enough period of time, they can kind of get tone deaf.
Yep. And
How do you keep it fresh enough that you know you're getting the good vision, the good
Right.
information?
It's a good question. Essentially, the question boils down to, do we have a wide enough sampling of analysts to make sure that we don't have, one or two analysts that have one vision of what the earnings are going to be, right? You want to make sure you have a wide sampling. So with the database that we purchased and we're doing our testing on, what they do is they actually track the Thomson First Call consensus estimate. So it's basically every single analyst, whether it comes from JP Morgan, Goldman Sachs, Barclays, or whoever their analyst house is, they'll aggregate all of their earnings data on all the 500 companies and then produce that as a trackable line. And so what we're doing is essentially we're saying, well, because since 2000, the SEC has come down very hard on analysts. Because when they were projecting Yahoo at $500, $600 and it went down to 100 and people lost their shirts, people said that the analyst had a responsibility in that. So analysts nowadays are actually very, very quick to start lowering guidance to try and keep the lawsuits away. That's the best way to put it. So analysts have become a lot more conservative in their expectations, but also to help us kind of mitigate erroneous analyst expectations, we're taking the sum total of all the analysts of all 500 companies. And essentially what you're doing is you're saying, well, what is the analyst projection of America? S&P 500 represents the 500 largest companies in America, and so we're taking the consensus estimate of the earning power of essentially America. And that's what we're using in conjunction with different technical tools to base one strategy.
So if you have a portfolio of 16 stocks, you're not looking at the analyst reports on just those 16. You're looking for all products.
Right, so what he's referring to, I'm sorry, I didn't get your name again? Joe. Okay, what Joe's referring to is essentially in our Visio portfolio, one of our strategies has 16 stocks. Analyst opinions actually don't come into play on how we pick 16 stocks. The analyst opinions only come into how we time the general market, when it's best to be risk-seeking or when it's best to be risk-adverse. So we use that as an overall market timer. But what we do is on the 16 stocks, we actually look at things like P/E ratio, dividends, price to book, percent increase in sales, return on equity for the last 5 years. We're looking at value metrics, and then we're looking at percent off 52-week high, relative strength in the last 3 months, 50-day moving averages. So we're combining the best of both worlds, both fundamental and technical analysis, to come up with which 16 stocks we feel have the most potential based on historical studies. So it's actually too bad we didn't have time to go through how the stock process works, because that is actually a very interesting presentation on how we use statistics and how we use modeling to identify different opportunities going forward. Anything else?
What is your position in Visio strategies? Are you like a principal executive or?
Well, the business strategy is just the name for the strategies. I'm working with John to come up with different strategies. I'll say, hey, John, take a look at what I just discovered. If you did this, this, and that to find a stock, here's the return, here's the drawdown. We'll work together to develop a strategy. But it's really more of just a name of what we're developing. It's not a company or anything like that. Yeah.
What company do you work for? Do you work just for yourself?
I do a lot of things. I'm a consultant for MarketSmith, which is a research provider. I work for my own company. Able to answer for anyone? Okay, so just a recap of today's topics. So again, in the market huddle, we cover things like support and resistance. Remember in January, we talked about heavy volume selling while we look at that. So all of this comes together to help us analyze the market. And not only that, but we are looking at different areas of the market to see what their intentions are. Remember, it's that telling poker, what cards are they holding behind their hand? We will continue to keep watching the 20-year bonds, and we will continue to keep watching key areas of support and resistance. This is really going to be critical. As you saw in those examples, those areas can help to determine when it might be best to be in or out of the market. Strategic investment strategy. Really what we did is we pitted market wisdom versus something that's quantifiable, something that's rules-based. And the main takeaway is this one strategy is just one layer of what we do for our overall portfolios. What you saw there was just one part of the decision-making process. All of our models have different ways of making decisions, different ways of weighting, basing bonds versus stock to adjust for risk. So this is really, in essence, what we've been working on the last 6 months. It's been super exciting. It's been super fun to work with John. And really, that's all I have for today. So thank you for coming to the Speakers Bureau.
One thing that have in your folder, you put your name on it as well. Matthew back toward